Welcome back to Good Returns. This is our weekly note, our deep dive into the weekly note on the Good Returns podcast. My name is Garrett. As always, I am joined by
Matt. Yeah, well, we're moving pretty fast today. We're going to get right into it. The world has changed very quickly in the past week, 2 weeks. We went from kind of coasting on a pretty good economic understanding of what's occurring to a genuine energy shock, headline grabbing, hiring freeze. But we can talk about a few different things. And one of those things could be that these are exactly the moments that you want exposure to the markets. And these are exactly the moments where great wealth transfers happen. But before we jump in, important disclosures, keep in mind that everything that we discuss in this podcast is for informational and educational purposes only, not to be taken as actionable individual investment advice. Always consult with a trusted advisor. And if you don't have one, we'd be more than happy to talk to you. Go to momentumwealth.us and schedule a free consultation, and we can talk about your specific situation. So yeah, let's hop in.
I'm going to put my watch on. Do not disturb because it's buzzing up my wrist. So we have sort of a risk off week across the board. We were doing some kind of internal metrics yesterday when we were at our office on Front Avenue and looking at sort of the moving averages and things that we use internally to sort of figure out where the puck is trying to move to. And we saw this kind of across the board where, prior to last week, it was sort of a risk-on, kind of a normal risk environment. Well, this week and kind of the latter part of last week, we're seeing like this sort of between the credit spreads, people moving into treasuries from corporate bonds, all these things that would suggest to us that the predominant theory may start to be risk off, and it's looking a little bit like that. We had the S&P fall 2%, largely due to higher fuel costs from war. I guess we call it a war in Iran.
That would be the appropriate name to use, I do believe.
Well, President Trump keeps calling it an excursion, which I don't know what that means, but so we'll call it a war here, I guess. NASDAQ outperformed, still down 1.5%, as people kind of rotate back into mega caps for safety, for some sort of perceived safety. We talked a little bit about that last week too. And then your laggard down 3% is Russell 2000, which makes sense because you got smaller companies trying to brace for whatever they think is about to happen economically.
Yeah, it's been very interesting. So, yeah, 10-year was falling last week, kind of cheering the housing thaw.
Yep.
Now we have oil spikes, yields drop. But, isn't this exactly the temporary shock the Fed has told us that they would look right through with their data dependency, kind of long-term outlook? They've always said they'll kind of ignore, small little shocks that have come across.
They don't know if this signifies a small shock, though.
That's to be debated. I think that this could be a setup where the exact opposite of what you think would happen is going to happen. I think we have seen this occur time and time again over the last 15 years, maybe longer than 15 years, where a lot of the things you think would make something pause could actually accelerate it. It's very interesting.
Well, I think it depends on how long whatever is happening for. And, you've seen the market responded favorably the other day when Trump said the war is nearly over. And then once the market closed, kind of walked that back a little bit. So I think just as long as this sort of uncertainty, it's always like this way, to your point, whether it's uncertainty from an excursion or a war, or it's uncertainty from something else, sort of always the market has a knee-jerk reaction and then over a longer term sort of takes it in stride. So yet to be determined how this will affect it. But you also have the 10-year falling, like you said, and we talked a little bit about mortgage rates last week. And so that sort of kind of did an about face because we had mortgage rates falling, not seeing that anymore. So is that a longer term kind of thing, do we think? Or is that, like you're saying, just kind of a temporary?
I think it's all temporary because you look at the trend of housing, both like the Truflation data of housing prices, the actual listing price changes in most of your major cities, and the actual slow CPI view of housing. You've got housing prices moderating and or coming down. You have rents either staying flat or going down. You have a lot of inventory coming on the market. I don't really think that there's a way to stop that moderation. Will it go to such a large, will it have such a large drop that we saw during COVID? I mean, that's kind of an outlier, but I think the trend towards a solid 5 handle for every mortgage or 4 handle, maybe possibly high 3s for a 10 or 15 year is all but a certainty. I do.
Well, you have also disruptors in the space. So you got Open Door, this company who's coming in and trying to remove the middlemen of that operation. We talked a little bit about AI doing that with like productivity. They're doing that in the housing space. And so they're actually like at a 3 handle, I think, on some of their mortgages that they're actually putting into place. And it's because they're removing kind of the middleman, all the fees and things, and just stripping it out to the bare minimum rate. And that's not even a buy down. So, it could be disruptive in that nature, or we could get falling rates once Jerome Powell is out. I mean, a lot of these things we'll talk about later about the Federal Reserve is all predicated on the fact that, this is Jerome Powell's Federal Reserve. But once he's out, he's replaced, it's going to be sort of a different vibe.
It will be a different vibe. And before we get into that and the unemployment / hiring concerns or issues, you bring up Open Door. Very interesting. And that is being powered by artificial intelligence and the efficiency that that's bringing to that particular company to disrupt and disintermediate the legacy mortgage originators, mortgage companies. That same effect is one reason why we're looking at, that and others is another reason why we're looking at oil struggling to break 100. Even with all of this chaos unfolding, it is struggling to break 100. You just think back to 2008, 2009, think back to some of the hurricanes, think about how you couldn't get oil below 100. And now, and this is not inflation adjusted, this is actual nominal $100. It is the inflation adjusted equivalent to oil not being able to break, $60 in 2008, 2009?
Well, we saw it respond almost immediately. Like, was that over the weekend where it spiked and then it dropped by the time the market opened?
Yeah, it hit 120 and then dropped like 84.
Yeah, it was crazy.
It's an insane reaction. And this is because, again, a lot of the things that you would assume the exact opposite may happen, there's a lot of compounding factors when it goes to oil. We have efficiency, we have technology, we have different areas of production that are being brought online. We have different ways to extract oil that will significantly increase the proven oil reserves. But all of that aside, that's kind of your traditional element, efficiency improves, you forgot new ways to drill. Kind of take that aside. Oil is its own worst enemy. When the price of oil goes up, it creates demand destruction that is never recovered when you have a technology that can replace it. So we may be drawn to parallels of 1973 with the Arab oil embargo against the West. And you think, okay, what was the response to that? We had rationed oil. Eventually, the big bodied vehicles gave way to the Japanese imports of smaller vehicles that were more fuel efficient that took years and years and years to do. So whereas, what happened in 1973 didn't really impact the car market until 1980, early 1980s, where people's choices were actually, I'm going to get a more fuel efficient vehicle that's smaller, et cetera, et cetera. Now, when oil prices go up and people are in the market right now for a car, they are more likely than not to purchase a hybrid or an EV today, and that creates permanent demand destruction. And we're already to the point to where, we were talking before the show, 1 out of every 3 vehicles in the world bought today is an EV. Now, I'm not even calculating in hybrids into that. 6 out of every 10 vehicles purchased in China is an EV. So that's more than half. And in the U.S., it's roughly 1 in 6. Every increase at the pump produces such a rapid change to where that growth will probably not be linear, but be on what's called an S curve, become exponential. And once that occurs, it is a permanent demand destruction tool. And I think that the smart money at the table realizes that when you see oil for temporary supply shocks, which it is a big supply shock, I mean, there's no doubt about it, at most, getting everything right can only replace about 40% of the stoppage. So at best, we're looking at a 12 million barrel a day shortage globally, and that 8 million barrel a day, doesn't calculate in the releases that can be done through the strategic oil reserves. But even with that, you see the smart money knows that this is extremely temporary, and every incremental dollar that it goes up creates permanent demand destruction. And it's because people now have a choice to go to a technology that doesn't rely on it. You just simply opt out.
Yeah, but it still affects you in other areas of the economy because a lot rides on transportation costs. Shipping, your Amazon packages, all that kind of stuff, when that goes up, it sort of has an effect where we have seen, and we'll talk about this in a minute, but we've seen, inflation kind of easing over the past. So the question is this going to be enough to make that stop? And are we going to see the results of that in a Federal Reserve who continued to be sort of, stubborn in their willingness to lower rates already? So is this going to enforce that? So do we see the market is sort of already taking into account a certain number of interest rate cuts this year? Is that going to lower? Again, all of this is predicated on the fact that Jerome Powell, who we know is not going to be there all year, but just where we are now in this position, the only thing we can see is the data that we have. So what does that look like for somebody who is, maybe they do drive an EV, but they're still going to see the effects of that in other areas of the economy with the oil prices, if it stays?
Yeah, I think the Fed's going to simply look through it. Supply shock is technically what central banks were kind of built to ignore. One way or another, oil will normalize because of the demand destruction and the dynamics that go into that. One way or another.
Yeah, but it's just when.
If oil goes to $500 million a barrel, it will be replaced this year with something. So it will normalize. And when it does, we'll still be sitting on the lowest unemployment and the highest productivity in decades. And that's kind of the bull market thesis for 2026. And people will be looking back and saying, I wish that, I had paid attention to that. But that's the bullish thesis. And we know, that those that are the perennial bears, the ones that are on the news, perma bears, they always seem the smartest as they come with all types of beautiful numbers and graphs. But
I think it's because a lot of people are driven emotionally by investing or the stock market or their money, financial. You're emotionally invested in anything financially related.
Yeah.
And so when somebody is talking about something that maybe you have as your secret deep dark fear, and somebody is talking about it, you're going to be, in a spot where you're going to want to watch that, and you're going to want to take in that content because it kind of confirms your worst expectations. Like, oh my God, I knew it. Yeah. I knew the market was going to crash.
Yeah.
And it's all day long with some of these guys, some of these YouTube channels that you can watch with these financial guys. That's all they have on, and I watch a lot of them. It's interesting content, especially surrounding commodities and gold and all this kind of stuff that they've been harping on for a long time. It's kind of gives them a leg up now because they're, they can hike their pants up and say, I told you.
Yeah.
High gold.
A broke clock is right twice a day.
Yeah.
That's the way I look at it. I really do. I think, and this isn't really even a dip. This is kind of like a sideways kind of action that we've been experiencing. I wouldn't even know if I'd qualify it as a dip, but even if you did, I think this is the dip before the pivot. I think this is the dip before the pivot.
Yeah, if you look at the S&P 500 year to date, 2.5% down. So, it's not, we're still very near all-time highs.
Yeah.
And so this is the other thing that's kind of funny about, these sort of existential crises is like the sky is falling when we're like 2.5% off, we're more than that off the highs, but when we're, less than 5% away from the highs.
Yeah, and I think that, and all this data again is telling you is that things can seem very uncertain, but if you tune out the noise and you pay attention to what's really going on under the surface, you can begin to build a lot of confidence and optimism for your retirement plan and for your strategy. And if you don't have an advisor that you're talking this through with, That's why it's very important to work with a trusted advisor who can get rid of the emotion, get rid of the noise, and develop a good, strong plan that gets you into assets that are poised and primed and for growth opportunities. And so, let's look at...
That's one of the reasons we look at decades over days.
Oh, yeah, absolutely.
This is like... we're in it for the long term. You're a long-term investor. You've got a while till retirement. And even if you're on the cusp of retirement, even if you're 50, 52, 53, 54 years old, whatever, 60 years old, and you're 5 years away from retirement or whatever your time frame is, you still have a long time frame because life expectancy is getting longer, medical care is getting better. You're likely going to live quite a while into retirement. So your time horizon is still fairly long. Now, you can shift your risk tolerance and things like that to kind of mitigate, if you're going from an environment where you're having an earned income to living on a fixed income, that's a big, huge shift. But there are things that can take place, but it doesn't necessarily mean that your time horizon is like getting smaller.
Correct.
That's kind of something we talk to people a lot about, that even if you're right on the cusp, even if you're retiring tomorrow, you've still got a long time horizon.
Yep, absolutely. Let's look at kind of the second takeaway, what we're looking at with jobs numbers. So we had expectations for a 60,000 gain in February. We ended up with a 92,000 loss. It still appears to be really what a lot of economists are calling a healthy hiring freeze is how they're interpreting it. It's very interesting because unemployment is still very historically low as it has been over the past many years. And it just appears that companies are still continuing to kind of hit the pause button, most likely waiting for cheaper capital, i.e. lower rates.
Yeah.
And that's the textbook setup. When you have productivity booming and hiring stops, margins explode, which means risk assets generally go up. But it is interesting because you did have the one note you had put in here, the Kaiser Permanente strike, which I think is the big health insurance conglomerate out in the West.
Mm-hmm.
Looks like there were 31,000 healthcare workers laid off through that strike. So if you add that back, it does mute that number pretty substantially.
We've had revisements in the employment numbers for a while. I mean, you can go back. It's like it spans multiple presidents.
Do you think that's the slow admission of the lag effect?
I don't know. I think that if you're a president, you have an administration that puts out data. I think, we saw it under Biden, we saw it under Trump too. I think that your goal is not to immediately put out bad numbers. If you can have it sort of secretly revised a couple months later, I'm not saying that they're doing it purposefully. I don't know, but I would think that would be appealing to you if that it was an option on the table. But I don't know why the numbers have been so off for the past few quarters. It's really interesting to me. I don't know.
The thing that makes the most sense to me is the beginning stages of the AI-driven productivity boom, where you're going to have companies that fall into two categories. They hired way too many people
during
COVID, or they realized through AI they don't need as many people. So both of those, AI affects both of those. It affects the former greater, right? If you hired too many to begin with, and now
I think both of those sides of the coin could be an argument to be made that it's an overcorrection, both on the hiring side and then also on the firing side. It's yet to be determined, but are we like throwing the baby out with the bathwater type situation with the firing of tons of people in certain industries because of the resurgence of AI? That will only be told by time, but I just wonder if it's sort of a similar thing to where we're like overcorrecting in COVID by hiring just an enormous amount of people because there's just money flowing all over the place versus like firing lots of people because now we have this productivity tool that can, there's good and bad sides to it. I think it's a double-edged sword, really.
I think the lower rates will bring about the truth of the matter when companies are able to get access to capital at more of a relatively normalized rate, because you can't think of what happened in interest rates in nominal terms. You can't think, well, it's just 5%. Well, we had 5% in 1998 or 1997. You have to think of the enormous amount of increase of debt that's been financed since then. I mean, trillions upon trillions of dollars in private credit, along with government debt. When you go from virtually, a quarter point to 5.25 point, that's a 1,000% increase. It's an enormous increase on operating capital. So I think as we get lower rates, I think the truth of that will become more apparent. And I do believe that is coming because, inflation was actually trending down pretty strongly before the events over the last few weeks.
Right.
We know how CPI is calculated.
Energy was a big part of that.
Yep.
As well.
Yep, it was. We know because we know how CPI is calculated. We know how they weight certain things over the others. We also know how long it takes for oil delivered in 3 months at higher prices to filter their way into actual goods and services. So outside of the immediate impact of gas deliveries at gas stations, it does take a while for it to get into the cost of goods. So, I think the path is still paved, maybe not as clearly as last month, but I do think it's still there for even the CPI, because if housing because housing is a huge component of CPI, and if the housing trend continues to do what it was doing, oil is not enough by itself to cause the CPI to get back into an upward trend if housing continues. Now, this is all ridiculous because they could track inflation in a true way and have real-time data instead of this, manufactured academic approach that's slow and
using old data.
Yeah.
Yep.
Things.
Well, there are companies out there that do that. We've talked a lot on this podcast about Trueflation, but they are a private company that does that with real-time data. And so it'd be interesting to see what they're saying with all of this now coming out. I haven't looked at them in a while, but it'd be interesting to see kind of what they're saying or how it's affecting it.
Yeah. But I do think it's interesting. I think the opportunities, I think that every year, regardless of model management and the trading updates that we do to real portfolios, we always have kind of an outlook that we internally put together, a framework for the theme that we approach the year in based on all available data. And our theme this year was a rotation into the broader market participants. Our theme was probably a disconnect from the correlation of assets that we saw last year, whether it be blockchain assets such as Bitcoin, Ethereum, whether it be gold, small cap, international, a dynamic that is very healthy. And we still are seeing that play out. Even with, again, the chaos over the last few weeks, we're seeing that play out in real time. We're seeing gold sell off.
Yep.
In a time where you would think that would not be the case. We're seeing dollar strength continue to rise, where dollar weakness was kind of the predominant theme in the past. So we're seeing some very interesting things.
Well, gold is cooling. It's not.
Yeah, it's not
dropping significantly.
Yes, that is correct.
You sound like 100%. Yahoo Finance now.
Yeah. No. Yes. Yes. No. It is. In other words, it's not. It seems to be gold's move continues to be more structural in reflecting the increase in money supply and the refinancing of government debts across the world that's going to be occurring this year, and not driven by an emotional rush for one asset versus the other. So it does seem to be more structural.
Yeah,
I plays into the bullish thesis of gold.
Yes, the analysis from a large part of the analyst sector has not changed. They're still having that target of like 54 to 6,000, anywhere in that range. And then I've seen higher than that too. I've seen somewhere between 8,000 and 9,000 for some people that are really bullish on it. But it's to be expected when you have a run up. I mean, year to date, you're up 17.2%. And we just said the S&P's down. So, I mean, there's a giant spread there with gold. If you look at a 1 year, up 68%. I mean, this is unreal. So it's not shocking that you have a period of time, where the last 30 days we're still up,
and we're seeing
still up half a point, flat, basically.
We're seeing some very interesting developments in the blockchain space. We're seeing Bitcoin outperform the indices, which has not really happened in a few years in a meaningful way. We're seeing the Ethereum network expand at a rapid pace in development and utilization in the tokenization of assets and payment systems. Just over the past week alone, I was reading a report that was very eye-opening on how quickly that area of technology is advancing. So we're seeing the benefit of diversification with growth assets not moving in lockstep. And I would put gold, as it has been since 2023, in that long duration growth asset category. So we are seeing different growth assets diverging from the overall indices, providing the benefit of diversification that they're built to do, that the portfolios are built to do. And we're really seeing that play out in real time, along with a broadening of the market, if not in daily returns, in daily volatility for sure. And so I think that's a really good thing. But I think that the theme to take away is that, both things can be true, that you can look at the Federal Reserve as being in a tight spot, but you can also look at it and say the soft landing is still here. The soft landing may have gotten a little noisier. There may be some...
a little bumpier?
Yeah, there may be some crosswinds as the plane is landing. But all complications in the market create an opportunity for those that have not yet decided to get serious about their retirement plan to do so. And we still hold the view, as does most market participants, that the Fed will be cutting, that oil will flow again, and that the greatest innovation wave is still happening. And I think we're probably to the point to where every crisis, and COVID started this, every crisis is an opportunity for innovation to solve it, and solve it much quicker than it has in the past. And, we'll see. The future is yet to be written.
Yeah.
Unless you want to take
like
bets.
A song or something.
Is it? Could make it into a song.
I think that's a song, yeah.
Could be our opening song of the podcast.
I'll let you sing it. Yeah, I mean, that's right. That's a big factor on people's minds that are kind of close to retirement, is the uncertainty of what you're going into. It's always you're kind of at a disadvantage if you have. We always talk about sequence of returns. So if you're going into retirement in an environment where the market is sort of not favorable to you, either it's flat or maybe it's down a little bit, then it's always more difficult to have that conversation about, I need income from the account. How do I get that in a market environment that is not ideal? Right?
Yeah, but how do you manage that risk as well? Because you have to have over a 30-year retirement. The overwhelming vast majority of those years, you have to have exposure to growth assets if you want to beat inflation and get the income that you deserve in retirement. But deciding how and when you do that also is a big factor in the stability of that income. There are periods of time, we saw this in 2022 and early 2023, where it was more favorable to lean towards cash rather than your fixed income positions. And there'll be periods of time where that will happen. And that's a focus on what asset plays what part in your portfolio for your goals, because everybody has different goals where they're at in life. But the overarching theme is, regardless of where you're at in life, you will necessarily have to have exposure to assets that are growth-oriented if you want to be successful. And history has taught us that time and time again, and this is no different.
Yeah, that's right. Well said. Yeah, I mean, we talk about that a lot. We just had a conversation earlier in the week about income with somebody who's on the verge of retirement as well, talking about the structure that we sort of use with guardrails and how, in times where the market is performing very well and we've got decent gains over a longer stretch period of time, you are very likely that you can get a raise in retirement. Now, on the opposite side of that, we have some thresholds that are down below. We call them guardrails, but we have sort of metrics for wherever the balance lies, to wherever, however much higher your income can go. And so that's an important key, too, to remember that your income in retirement doesn't necessarily have to stay static. You can be in a position to where if your assets are doing well, if you're getting that good growth, you can potentially take more income than you otherwise thought you might be able to.
Yeah, and then on the flip side, if you're in a position where you don't necessarily need to take, and you can be tactical with that lower guardrail and say, what, we know that not everything is straight up. We're going to have periods of volatility sideways or down. And if you're in that period of time and we have this dynamic guardrail approach, you can always simply say for the next 6 months, maybe I don't need $5,000 a month. Maybe let's go to 3,600 and let's be dynamic. And that is a powerful tool as well to be able to reinforce that long-term growth-oriented approach, because you'd much rather have that dynamic aspect than, say, be locked in, say, on an annuity-type income that's just 3% a year, regardless of what happens, and you end up ultimately losing long-term with that approach. But let's talk real quick here on a few financial planning anecdotes. Let's spring this on Garrett. Some real world.
Okay, let's do it. We got a few minutes. We don't want to get too much short. We got a few minutes.
Let's go real world anecdotes.
Okay.
Yes, and anybody that knows me knows using R's and W's very close together in a sentence is a recipe for me to mess words up. But yes, real world anecdotes here. Actual stories and identities obviously will never be revealed, and some examples may be embellished a little bit to further skew the details. But a lot of times we get asked about life insurance, and oddly enough, it is not in the age bracket that you would think. Obviously, when you're younger and you're starting a family, life insurance is a great tool. Generally speaking, for the younger crowd, term makes the most sense because you just want coverage as you kind of get your feet off the ground, get your income coming, get your assets built up, get your equity in your home, and eventually you're in a place where you don't really need it, and you can keep it if you want or add more. And then sometimes we get asked about insurance for some of our retirees for a few different things. One is long-term care, and the other is just life insurance because of having the assets but still owing on mortgages and knowing the needs of those that you'll leave behind. And it does make sense sometimes. So, we recently had a client that wanted to kind of combine a mortgage payoff with a kind of a final expense policy that she could continue to spend what she needed to in her retirement account for income needs and not really have to worry about keeping a certain amount in there for the mortgage or for final expense. And in that case, it really was a blended approach between a permanent policy, which generally you get a lower rate of return for, and a term policy. So, you have to be very open-minded when you have these desires, trying to figure out how do you solve for your estate's needs in retirement. And we are asked about that a lot, and a lot of people just think that because you're older, an insurance policy is just really not appropriate. But I've definitely seen just in the last few months some really strong cases, in particular of using some complex strategies, term mixed with permanent, to kind of solve for that need at a relatively low cost. So always be open-minded and talk with your advisor about your needs. Sometimes it's appropriate, sometimes that it's not. But I just always find that interesting because generally most of your financial media personalities will really, never endorse an insurance approach in retirement. And I would say most of the time that's probably right, but there are cases, and I've dealt with them over the past few months, that it makes perfect mathematical sense to do it, and it solves for those concerns and being able to continue to spend in retirement and not having to say, if you have $500,000 and you still owe $200,000 or $250,000 on your house, you don't have to worry about keeping that $200,000 or $250,000 locked up just to pay the house off when you die. So you can continue your spending and continue your asset growth over retirement without worrying about a down market or worrying about overspending and then your heirs still having to pay off the mortgage when that's one of your main concerns. So it's always very interesting, and it just goes to not everybody's situation is the same. Not all advice is not good advice for everyone all the time. And that's why it's very important to reach out and have a conversation with a trusted advisor. Go to momentumwealth.us. We're more than happy to talk about your specific situation. But who would have thought we would have ended the podcast with a story about boring insurance? Who would have thought?
Not I.
I surprised you.
It's always keeping it spicy on this show. Anyway, we are coming to the end. It looks like our cameras are heating up too, so we need to... It is very hot in here today. In case, nobody knows that, but it's very hot in here. Anyway, we will be back next week with another weekly note. As always, any questions, concerns, if you want to reach out and start a conversation, please do so. like, comment, subscribe, all of the above. This will be on any platform you have the ability to listen to it on. So we will see you guys next week.
Yeah, take care.